Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
Now, one thing I want to make sure that we talk about really quick is I have a question for everybody. And this question is one that I ask everybody on the presentation. And I also ask people when I'm doing one-on-ones, but what in life should you control? Now, there's lots of things in life that we definitely should control, but there's three main things. What's something in life that you believe that we should control? First one, actually, by the way, is what Bliss just said. It is money. Money is one of those things that we should control, because if you're not controlling your money, most likely somebody else is controlling it for you, right? When you put your money to retirement plans, into the market, your money is being controlled by somebody else, okay? The next one right there, time. Time is that one thing that I love to control above all else. I love time beyond money, beyond anything else, because it's that one thing that once it's gone, I can't get it back. Money can come and go, but time, we only have so much, and we don't even know how much time we actually have. But in order to control time, you've got to control money, because if you don't have money to control time, then you're going to be trading time for money. But there's one thing above all else that I believe that you should control before time and money, and that is what's going on right here. It's your mindset. It's knowledge. If you don't have the right knowledge or the right mindset or the right belief system, that's called subconscious programming, by the way. If you don't have that right mindset, it's very challenging to control time and money. So as we go through this presentation, we're going to be talking a little bit about, obviously, your mindset around how we view money. So mindset and money are two of the big things we're going to be challenging here. And to kind of lead this off, there's a quote that we like to share here at the BYOB, and it's by Will Rogers, and it says this. It says, the problem in America isn't so much what people don't know, it's what people think they know that just isn't so. Now, as we go through this presentation, just keep an open mind. That's my request for you. Keep that open mind, because we're going to be challenging some of those thoughts around money, around our belief systems. All right, now I want to share this with you. So this is kind of an interesting thing to think about. I want you to envision that we take 100 people, 18-year-old kids, by the way, so 100 18-year-old kids, and you gather all of them, and you put them into a room, and you ask every single one of these 18-year-old kids, right, where will they be at the age of retirement? Are they going to say they're going to be poor? Or are they going to say, I'm going to be successful, I'm going to be wealthy, I'm going to be, rich, all that kind of stuff? Of course, they're going to say, I'm going to be successful, all that kind of stuff. They're not going to say, I'm going to be poor. But here's the crazy thing. Here's the real truth of it. Out of those 118-year-old kids, when they turn 65, let's just say 65, only five out of 100, 5% of them will be financially secure at the age of retirement. Only 5%. And that to me is extremely crazy, considering that we live in one of the wealthiest countries in the world with opportunities all around us, yet for some reason, only 5% are going to be financially secure. Not free, by the way, just secure. And by the way, this stat does not come from thin air. It comes from the Social Security Administration, where they say 5 out of 100 people will be financially secure at retirement age. So let me ask you all a question here. Do you want to be one of the 5% that is financially secure at the age of retirement? Do you want to be one of those 5%, or do you want to be one of the 95? Obviously, we want to be one of those 5%. And so what we're going to be talking about here today is one of the strategies or ways that we can actually accomplish that. All right. Now, quick, background on who I am. So obviously, my name is Brian Fouts. I went to school. I did that whole traditional path in life. I went and got a degree in construction management. That's my degree right there. I don't even know where it's at. It's somewhere probably in my office, all buried in dust, all that kind of stuff. But when I went through life, I did what I call the hard way. And a lot of you probably can relate to this. I was raised lower income. My family did not speak about money. We didn't have, we had wood heat growing up. My family's a great family there. My parents were still together. But I didn't really understand money when I was growing up. And I just was told to follow that traditional path, right? Go to school, get good grades, go work in corporate America, save into that 401k. I did all this stuff, by the way. And then eventually got the house with the mortgage, had the growing family, and I was living the American dream, or so I was told. But to me, it felt like the American nightmare because I always felt like I was drowning in debt. And eventually, this is like after 10 years in corporate America, I was at a doctor's office and I picked up this financial magazine. And there's an article on it talked about millionaires and how they know their net worth. I didn't know mine. So I said, oh, that's probably not a good thing. So I went home. That's the actual paper there. I don't have it anymore. I lost it, but I took a picture of it one time. I was a negative net worth. That was my net worth. It was negative after 10 years. And I did the math and it was going to get worse and worse and worse. And I was like, what the bleep is going on? This doesn't make any sense. So I knew I had to do something different, right? If we want something different in life, we've got to do something different. And then my grandfather, who was my idol, quick, side note here, he retired in the late 60s, worked really hard to have a good retirement. He was known by the entire community. He was a football coach, all the kind of stuff. But unfortunately, he had this whole plan in retirement. He retired and not even, I think it was maybe not even 2 years or a year into his retirement, he actually got sick. He got leukemia. He got Parkinson's disease. He was on dialysis and he ended up passing away fairly young and never really got to live that life in retirement. And his last thing he told me, this was a big thing for me. He said, hey, Brian, go live your life today. Don't wait. And so that kind of set me off on a different trajectory. And eventually I quit my jobs. I got into real estate, got into what we're going to be talking about here today. And I ended up started helping other people do this. And I started helping other people do infinite banking. This is one of my businesses where part of that business was actually teaching people this concept. And, just to kind of show some of the things that I've done in my past. This was in 2021. This was during COVID, by the way. This business was doing over 2 million in revenue. And why I was able to do that was because of one of the things we're going to be talking about here today, infinite banking. It allowed me to do that, but also allowed me to control time. So time is my biggest thing. So the last, probably 7 years, my family, we've done a lot of cool things. We've been able to travel, but I created that life and I did something different. So part of what I want to talk to you all about here today is, when you go through this presentation and see this concept, just understand it is something different, right? But if you want different results in life, we've got to look at doing something different. And one of my biggest joys in life is being able to actually teach this to other people. This is actually a high-level mastermind where I was actually talking about this concept, helping other people do this kind of thing. So I love what I do. If you guys can't tell, I talk pretty fast because I get pretty excited about this concept. And I love just sharing how it can work. So let's kind of get into it. Now, one thing I want you to understand, though, about this concept, infinite banking, is that it is not a new concept. It's been around for a long time. In fact, Robert Kiyosaki, his book Second Chance, talks about this. And one of his advisors, I know about 3 or 4 of his personal advisors. They're acquaintances of mine. One of them was my mentor that taught me this whole concept. So a lot of the people at that level, they're doing this. Tony Robbins, in his book Money Master the Game, he talks about this concept. I've been to 2 or 3 of his events. They're awesome. Walked on Fire, all the kind of stuff. Then, of course, we have the book called Becoming Your Own Banker by R. Nelson Nash. He's the one that popularized the term infinite banking. I definitely recommend these 3 books. They're very good. Obviously, Becoming Your Own Banker is one of the cornerstones of this concept. Additionally, some friends and mentors of mine, Brent Kessler and Chris Naugle, they have a book called Mapping Out the Millionaire Mystery. And Chris also has the Private Money Guide. Now, we also want to understand, throughout history, who has also been using this concept because it's been around for a long time, over 150 years. Who else has been using this? Well, this is kind of a cool story. So Jim Harbaugh, he was one of college's top paid coaches. He used this concept, or the college, by the way, used this concept to pay him his bonuses and his salary. And so it's kind of cool how they did that. Additionally, you guys may remember this gentleman, Joe Biden. Probably heard of him before. He actually has 6 of these policies, 6 of these accounts. Walt Disney. So Walt Disney, he wanted to start Disneyland. It's kind of a cool story because he couldn't get financing. No banks would finance the start of Disneyland. And so eventually he had a policy. He became his own bank and borrowed from it and created Disneyland. So without this concept, we probably wouldn't have Disneyland. It's kind of weird. McDonald's. So Ray Kroc, when he partnered with McDonald's brothers and eventually took over McDonald's, he grew McDonald's, but he used his infinite banking policy, this concept, to actually grow the business because he didn't have any cash. So that's how he paid for employees, did all that kind of stuff. The Pampered Chef, so she, when she started Pampered Chef, she used a small amount from a policy. Of course, that grew into $1 billion business that I think Warren Buffett now owns. And then, of course, lots and lots of wealthy families and also average, everyday families have been doing this for years, for hundreds of years. Morgan's, the JP Chase with the Vanderbilts, with the Rockefellers, the Harrises, and now everybody else. And by the way, there's a book called What Would the Rockefellers Do? We actually have that. Definitely recommend checking that book out as well. It's a good take on the history of how the Rockefellers started doing this back in the 1800s. So been around for a while. Now, also what I want you to understand is I want you to understand what this will do for you. What will infinite banking help accomplish for you? So number one, it creates guaranteed generational wealth, tax-free, by the way, day one, not year 40, but day one. It allows your money to grow uninterrupted, compounded for the rest of your life with guarantees. I love the word guarantee, by the way. It's awesome. But your money's going to grow for the rest of your entire life, compounded. It takes control of your money away from the big banks, away from Wall Street, and puts that control into your hands. Remember at the very beginning, I talked about what do we want to control in life? Obviously, we want to control money. So this does that. It helps you accomplish that very quickly. It also protects your money. So if you're going to make your money, we also want to keep and protect our money. So this can protect your money from lawsuits, from bankruptcy, divorce, and creditors in most states, by the way. It's state specific, by the way. So not every state has all the protection, but a lot of them do. And then, of course, mainly it does this. It allows you to be the bank for things you may normally use a traditional bank for. So think of things like buying real estate, investing, college, cars, homes, investments, all those kinds of things. But the cool thing is you can do that while having all of the benefits listed above. So it's not like you can do one or two things. When you have infinite banking in place, it's doing all of these things at the exact same time. All right, now I mentioned mindset. I mentioned that, to go through and understand infinite banking, it does require a bit of a mindset shift, all right? So I want to give you this analogy. This is called the backwards bicycle. Now, think back to when you were a kid. You learned how to ride a bike probably pretty quickly, right? Your parents will push you down a hill and let go, and hopefully you learn how to ride it. But eventually you're going to learn how to ride the bike, right? And 10 years later, 20, 30 years later, you can hop on a bike and still ride it because you're programmed on how to ride a bike. But here's the thing I want you to think about. What if you hopped on that bicycle and it did not operate the same way? What if you hopped on it and it was the backwards bicycle? The backwards bicycle, by the way, you can see it right here. If you turn the handlebars to the left, the tire goes to the right. Vice versa. Go to the right, tire goes to the left. You can Google the video, by the way. It's called the backwards bicycle. It's hilarious. Do it after the presentation. But this guy hops on it and he cannot ride this bicycle to save his life. But guess what happens? Over time, he practices and practices. And guess what happens? Eventually, he can ride the backwards bicycle, right? That same thing around money. Once you learn how money really works, you can ride the backwards bicycle, or you're going to understand how money can work better for you. But the really interesting thing is this, is once he got back onto the regular bicycle, he couldn't ride the regular one anymore because he had reprogrammed his mind on how to ride the backwards bicycle. So it's the same thing around money. Once you learn how money works, it's very hard to go back to the regular way of thinking around money because we have changed our mindset. So I just want to kind of give that analogy there for you. Now, to understand how money works, we also have to understand why more people aren't successful, because people always ask, well, I wish I was more successful. Why am I not more successful? Why is my brother-in-law over here, who's dumb as a box of rocks, very successful, but I'm not? So here's kind of the mysteries of money, as I call it. So one, what kills wealth? Taxes, right? I don't mind paying taxes, but I'm a lot happier paying a lot less, by the way. So taxes kill wealth. Inflation, the hidden tax, they call it. Volatility. Interest, by the way, interest is disastrous. The average family pays around $19,000 or $20,000 per year in interest. That's average. More, by the way, if you have a house, you're paying a lot more probably. Mindset, okay? How does mindset, work when it comes to money? Well, following that status quo, fear of missing out. Fear makes us do things that we probably shouldn't do with money. Life just happens, generally life. And of course, what we're taught in life, what we're taught around things around money changes our mindset and can also actually prevent us from being successful. All right, some other things I want to make sure that we're clear on. So what is money? So as we go through this, money is just a means of exchange. That's all it is. Also, what company uses compound interest? Actually, not many companies use compound interest. People think banks do. Banks don't actually earn compound interest or use it. They charge you interest, but they don't really use it themselves. The only way the banks really actually use compound interest is by buying life insurance, by the way. It's kind of crazy. Another thing to think about is this. Are your dollars worth more today or in the future? Think about a dollar bill, how much you could buy in a candy store 20 years ago versus today. So we know that our money is worth more today than it is down the road. So we want to make sure that we're actually getting that value today and not down the road. Well, taxes go up or down. Obviously, we know that taxes are probably going to always go up, unfortunately, which means that we got to protect our money and get it out of that system as much as possible. And then the other thing I want you to think about is, would you wait to eat bread or milk? Now, why am I asking this? Why am I asking, would you wait to eat bread or milk? Well, you wouldn't, because if you're going to go spend money and buy bread, buy milk, you're not going to put it in the freezer and wait 5 years to consume it. Even if it doubled in numbers, you still wouldn't want to eat it 5 years down the road because it doesn't make any sense. But here's the thing. We do that with money all the time. So think about your retirement account. Think about a 401k. We'll put money into a 401k and not touch it. We cannot really use it until 30, 40 years down the road, at which time taxes have gone up. We know that our money is worth less down the road than it is today, but we do that with money, but we don't do that with things that money buys, like food, like a car, clothes. We use those things, we consume them, but we don't do that with money. So it's kind of a weird thing. So what we're going to be talking about here today with infinite banking is, how do you do that? How do you use your money today and down the road, right? That's getting your money working for you. All right, so now we want to talk about how our money flows. So if we were going to be talking about being our own bank, we have to understand how money really flows. So let's look at a traditional transaction that involves a bank that most of us are familiar with, and that's going to be buying a car. So let's say that you're going to go buy a car. Let's just use $25,000 as a round number, and you're going to go to your bank. Your bank has your money. So you have $25,000 in your bank. Let's just assume that you have $25,000 of cash and it's parked at your bank. And you're going to go take that cash out and buy the car with cash. But guess what? The bank says this, hey, Mr. Banker Bob. So Banker Bob says, hey, Brian, before you take the cash out, what if I do this for you? What if I give you 4% on your money? So I'm going to pay you 4% on the money that you leave in the bank, and I'll give you a loan of 6% for $25,000 so you can go buy the car, and we'll do a 60-month term. That's $500 per month, right? So once again, you'll leave the money in the bank. They're going to give you 4%, and they're going to give you a loan of $25,000 at 6%. Does this make sense? Would you do this? Well, here's the math. Monthly payments on the car loan are $483. Future value of all those payments is $28,999. But here's the crazy thing. The money in the bank earning 4% has a future value of $30,525, which means you made $1,526 by leaving your money in the bank and getting a loan against that money that's in the bank. Now, some people say, well, Brian, well, wait a second though, but if I use the cash to buy the car, I'd have no payments. Well, my question back to the person that says that is this: how'd you get the money in the bank in the first place? I saved it. Every month I saved money in the bank. Okay, if you used a $25,000 to buy the car, are you going to save back into the savings account again every month? Yes. So this situation right here is no different, right? It's no different. The cash flow is exactly the same, except you made $1,526. Now, this involves a bank. What if you own the bank? That's the whole concept here. Now, people say, well, Brian, wait a second. How are we making money when we're only earning 4%? It's because you're earning 4% on a increasing balance and you're paying 6% on a decreasing balance. It's just math. So this is just kind of in a nutshell how banking kind of works. So what is the money multiplier method? What are the three things we're going to be talking about here today? Number one is the machine. What is the machine that makes this work? The next thing is going to be the marathon. Building wealth is not a sprint. It is a marathon. We're going to go through that. And then, of course, the last thing, everybody's favorite topic, how do we build wealth? How to build a legacy? The millionaire. Okay. So that's the three things. So let's get into the machine. So what I want you to think about, I want you to think about infinite banking like a car. A car has, steering wheel, radio, windshield wipers, lights, tires, all that kind of stuff. But if that car, infinite banking, by the way, has no engine, can it go down the road? Of course not. It can't go down the road, right? It has to have an engine. So what is the engine that makes infinite banking function and work? It is nothing more than a specially designed dividend-paying whole life insurance policy from a specific mutual insurance company. Now, there's about a handful of companies that do this, by the way, that do it well, and that's who we work with. So that's what we're going to be talking about here is, what is that machine? Now, the other thing people say is, well, Brian, why life insurance? Well, I'm healthy. I don't really need life insurance. Keep it in mind. This is the engine that makes infinite banking work. Also, who is buying life insurance? This is kind of a crazy thing. Who is one of the biggest purchasers of this kinds of life insurance? Well, it's banks, by the way. So traditional banks, they own more life insurance these kinds of policies, by the way, then they're buildings and real estate combined. And you can go look it up. It's called BOLI, or bank-owned life insurance. So really what we're doing is doing the same things that banks are doing with your money. We're going to go do the same thing. Bypass them. All right, so to understand why we want to be our own bank and understand how this machine works, we've got to understand where our money goes. So let's just say that for every dollar that comes in, where does it go? So we already showed you how you can earn 4% and pay 6% and make money, okay? So to understand why we want to be our bank, we have to understand how a bank flows your money. How does your money flow when you give it to a bank? So let's just assume that you give a bank, let's just say $100,000. And let's say they're going to be very nice and they're going to give you 4% on that money. Does the bank just sit on that money? No, they don't, right? They do not sit on your money. They put that money into motion. So maybe they lend it back out on a home loan. Maybe it's a mortgage, a 7-year ARM, something like that. But what does the seller of that home do with the money that they got from you or the bank? Well, it goes right back into the bank again. What's the bank do with that money? They put it right back out into motion again. Maybe it's a car loan at 8%. What's the car company do? They put it right back into the bank again. What's the bank do? Maybe they lend that money back out on a home remodel at maybe 9% or something like that. What's the contractor do with the money? What do the subcontractors do? It goes right back into the bank again. Bank does something else with it. Maybe it's a debt consolidation at 12%. What's the credit card company do? Puts it right back into the bank again. So what is going on here? What's happening is the bank is paying you 4%, but they are making 500% more on your money than they're paying you. It's just math, by the way. This is how they do it. Now, if you're saying, well, does that really happen? Yes, by the way, you can actually look this up. So you can go to bauerfinancial.com. It's right there. And you can see that banks make between 400 and 1,300% on the money that you leave there, which is insane, by the way. That's insane. But that's what banks are doing with your money. Okay. All right. So now I want to look at this. This is where I was getting to this slide here. So how do we spend our money? So this is like the annual pattern of spending, because if you want to say, well, Brian, why would I want to be my bank? This is going to hopefully illustrate that for you. So this is how we spend our money. So for every dollar that comes into your hands, around 20 cents goes to automobiles. Okay, 20 cents. Around 30 cents of every dollar goes to housing. So think, mortgage, things like that. 40 cents goes to everything else. So think of like travel, entertainment, food, clothing, all that kind of stuff. That's 90 cents right there. So 90 cents of every dollar goes right back out the door. What's left? Right around 10%. That's your savings, right? So when you go and talk to a financial advisor, they're not really going to talk to you about auto, housing, everything else. They're going to talk to you about your savings, save more money, right? We're not going to talk about your savings. What we're going to talk about is how much interest are we paying on these other things that we can recapture. All right, so let's start with your savings, 10%. So for automobiles, 20 cents goes to automobiles, but 5 cents, so 5 cents of that is interest. What if we recaptured that back into our savings? Okay, our savings would go up. Housing, so 30 cents goes to housing, but 25 cents of that is interest. What if you recaptured that interest? Your savings would go up. Everything else, so 40 cents goes to everything else, around 5 cents of that interest to credit cards. What if you recaptured all of that as well? Your savings goes up. So what we're going to be talking about is really, how do we recapture interest? Now, one of the best ways to do that, to capture interest, is to not pay interest to somebody else. What is that? That's called debt. Okay, so let's look at some examples. So we're going to look at a car first, because when most people go and get a car, you're either going to pay cash, which you lose out on the future value of the money, or you get a car loan, which means you're paying interest to somebody else. So what I want to illustrate here is, how do you use infinite banking, this concept, be the own bank, to actually pay for all your cars and actually gain wealth at the exact same time. This one is kind of pretty cool. This is a good example, but what I want to share with you first before getting to that is this right here. So this is what we call a tabular detail of a policy. You're going to see a couple things on this. So I want to make sure we're clear on this. So for one, you're going to see a thing called deposits. So with life insurance, you have a premium. We call those premium deposits because you get something of return or value out of it. You can pull the money back out. You'll see that right here. Okay. Age. So a lot of people say, well, Brian, if I'm getting life insurance, can I get one at 50 years old, at 65 years old? Yes, you can, because age really is not the focus here. Because you can get policies, by the way, on other people, but yeah, you can get policies all the way up into your 70s, by the way. Death benefit. So when people think about life insurance, all they think about typically is death benefit. In this situation, we're going to focus on the living benefits, not the death benefits, living benefits, okay? Now the death benefit is a benefit, but it's not the focus here. The focus is on the living benefits. So let's go ahead and look at this. So we're going to put together a policy here. And in this example, we're going to deposit $10,000 into this policy every year for the first 7 years. Okay, that's a premium deposit right there. That deposit is going to get us what we call cash value. You'll see that on the right-hand side. Cash value is what you can borrow out. Now, this is a very, very conservative number, by the way. In most cases, there are a lot more, but once again, I want to show you the power of this thing at a very conservative number. So at the end of year 3, you'll see it right here. At the end of year 3, this person says, hey, I want to go buy a car. I'm going to go to my policy, which now has around $25,000 of cash value. I'm going to take that back out. Now, that's called a loan, a policy loan. I'm going to go buy a car with cash. But guess what? Since I am my own bank, I'm going to pay my own bank back. And this person said, hey, I'm going to do it at $500 per month or $6,000 per year. You can see that right there. That's that car loan payment right there. So what is the math on this? Well, here's the math. In the first 7 years, this person put in $70,000 premium, $30,000 loan payment. That's $100,000. But what did they do? They took out $25,000 of cash. So in reality, they only put in $75,000 into this policy. Now, this example is a car, but what if they put that into real estate or a cash flowing asset? Kind of changes things, but let's stick with the car example here. So you put in 75, but you'll see right here, after you paid this loan all the way back, you have $67,000 of cash value inside this policy, which means you've recaptured 91 cents of every dollar. Now, by the way, this is conservative. In most cases, that would be 100%, but I'm going to use 91% here. Now, let's go ahead and look at years 8 through 12. Now, this person says, hey, guess what? In years 8 through 12, I'm going to put in 0 deposits back into my policy. They're going to take their premium deposits down to 0. That's an option, by the way. But guess what? Even though they're putting nothing into this policy, the cash value still grows. Pretty incredible. So you'll see it over here. Cash value still grows. In year 8, their daughter turns 16. Mine turns 16 next year. Help me. In 1 year. And they go to buy another car for their daughter, as an example here. So same thing, borrow $25,000, and they're going to pay that back over the next 5 years at $500 per month. What's the math? They put in $30,000 via loan repayment, but they took $25,000 out of cash. In cash, that means they really only put in $5,000. But here's what happened. During years 7 to years 12, the cash value grew by $23,592, but they only put in $5,000. Does that seem like a good deal? Now, the next thing I want to mention here is what's going on here. So in the 12 years we see here on the screen, they put in $75,000 here and $5,000 here. That's $80,000. But what do they have access to as far as cash value goes? They have access to $91,473, but they only put in $80,000, and they own 2 cars 100% outright. So they made money and they own 2 cars outright. That is how this can change the game for you. Once again, this is just an example of buying cars. What if you invested the money into a cash flowing asset? So there you go. Now, there are 3 rules that we want to kind of talk about when it comes to infinite banking. You'll see them right here. Rule 1, pay yourself first. Rule 2, pay the loans back, be a responsible banker, and then recapture and recycle. So what are those? Pay yourself first. What that means is where your money goes first is very important. Most of the times it goes right back out the door to pay somebody else. But in this example, we want to recapture that back into our hands. Pay yourself with interest. If you're going to be a bank, be a responsible banker. All right. And the last one is recycle and recapture your money. What that means is cycle it through the infinite banking process, the concept. That's what's going to build wealth for you. So this works for a car. What else does it work for? So one of the other big things that steals wealth away from us is debt. Most people are just buried in debt, which just takes money away every single month, every single year. People are just so sick and tired of debt, right? I've been there. In fact, I'm paying some off right now with one of my policies. So what I want to show you right now is how you can use infinite banking to recapture that debt back into your hands and pay it off a lot faster, because there's 2 steps to building wealth, in my opinion. 2 main steps. There's lots of steps, but these 2 right here for most people. 1, stop having bad debt, stop paying bad debt, right? Capture that money back. And step 2 is now put that money to work. So this is step 1, which is getting rid of that bad debt. So in this example, this is a 45-year-old chiropractor doctor. He has 9 third-party debts. He has $478,000 in debt. Not a small amount of money, by the way. His total payments every month are $5,777, almost 70 grand per year, right? Now, if he pays these debts off as scheduled, it's going to take him 19 years. Does that sound like a long time? I mean, to me, it does. 19 years. That's insane. And guess what? He's probably going to get into more debt and more debt and more debt. So, and this is, by the way, this is a case study. And so this doctor said, hey, I want to do something different. So he's going to start a policy. So he's going to do a policy at $25,000 per year premium. Okay, you'll see it right there. So he's going to deposit $25,000. Now I'm going to stop here for a second because a lot of people say, well, Brian, I can't put in 25,000 per year. Well, this is his number, by the way. Your numbers are your numbers. This is his number. Now, where did that $25,000 come from? Keep in mind, this is a doctor, so he has, higher income, but he was putting a lot of money into traditional retirement strategies, IRA, 401k, and some other account. I can't remember what it was. So all he did was he said, hey, I don't like my 401k because it's getting just hammered in the markets. It's going up, it's going down, sideways, perpendicular, whatever, right? So he says, I'm going to take $25,000 that was going to my 401k and I'm going to redirect it into infinite banking. So his cash flow did not change. Keep that in mind. So day one, 25,000 goes in. Within 30 days, he has access to $14,863. Very conservative numbers, by the way. Typically, they're a lot higher, but once again, I want to show you conservative numbers. So what's he do? He goes to his bank, he borrows out $14,000, and he pays off the Discover card, Lowe's card, and part of the Nordstrom's card. All right. His debt drops, and his monthly payments drop by $448 per month. Now, year two, what does he do? Well, keep in mind, during the prior years, he does not spend that $448 because he captures that. So he takes that money, $448, and he holds on to it. All right. So in year two, he deposits another $25,000 into his policy. The cash value jumps up by $16,000 and change. And the payments that he was capturing back into his own pocket, the $448, was $5,000 and change. So total cash is $21,945. What does he do at the beginning of year two? Borrows that money back out, pays off Nordstrom's, Wells Fargo, private loan, and part of his BMW, probably a car or a motorcycle, pays that off. Okay. Now his debts have dropped and his monthly payment has decreased by $1,917. Pretty awesome. Does the same thing. He recaptures the $1,917 back in his hands. Year three, another 25 goes in. Cash value jumps up by $25,000 and change this time. The payments back to himself is $23,004. And the total cash he now has available to borrow is $48,545. So that's what he does. He borrows it out, pays off BMW, pays off West Marine, part of the condo. His monthly payments have now dropped by $3,677. Now, I'm going to pause here for a second because remember what I said? This is the marathon, not the sprint. So this is what's happened in 3 years. What's happened? He's put in $75,000, but he's also borrowed back out around $55,000. So the question is, well, how much is left in his policy? Because keep in mind, these policies grow, called dividends, by the way. They grow no matter what you do. So is he earning dividends on $20,000, which is the 75 less 55, or is he earning dividends on the full amount? It's the full $75,000. Even though he's borrowed 55, he is still earning the same dividends. His cash value is growing every year, even though he's borrowed against it. Pretty powerful. Let's go to year four. Year four, 25 goes in, cash value jumps up by $26,304, and the payments of $3,677 back to himself are $44,000 and change. So he has $70,000 of cash available. He borrows that out and he pays off a big chunk of the condo. Now, his payments don't change though, because the condo and the house are amortized loans. Amortized loans, if you pay the principal on those, the payment does not change. So his monthly payments, the amounts he's recapturing, it doesn't change. Okay. So in year five, 25 goes in, cash value goes up by 27,000, payments back to himself is 44,000, and the total cash he can now borrow is 71,225. So what's he do? Borrows it back out, pays off the condo, pays off a big chunk of the house, and now his monthly payments have dropped by $4,556. Pretty awesome. And he's got one debt left. So year six, something happens. So this doctor said, he goes, hey man, I'm loving this. This is incredible. What if I reduce my premium from $25,000 down to $10,000 and start a second policy? Now, why would he do this? Why would he start a second policy? because he can only put in $25,000 into the first policy, but he wants to put in $35,000 now into infinite banking because he's got more cash flow. So what's he do? Reduces premium on the first policy and he starts a second policy. So the first policy, he puts in $10,000 in year 6, but the cash value goes up by $13,000. And the second policy, same as the first one, 25 goes in, cash value available within 30 days is 14,000, and the payments back to himself are $54,000. So he has over 82,000 of cash value that has gone up. So what's he do? He pays off the house. His monthly payments are now 0 going to the credit companies, and he has paid off all of that debt. Now, here's what I want you to understand though. Where's all the debt gone though? The debt actually went into his policy loan. So for the rest of year 6, and I can't remember how much it was part of year 7 as well, he's taken the $5,777 and he's paying back his policy loan. And so at the end of year 7, he's got 0 bad debt. He's got multiple 6 figures in his policy of cash value that he can now go invest and put to work to create more cash flow in his life. So he paid all of his debts off in 7 years, built wealth while at the same time, instead of taking 19 years and having 0 wealth. So now if you're saying, well, Brian, I have no idea how to do what you just said, that sounds like a lot of math. It is actually some math, but guess what? We've got you covered. So we have something called the Vault. The Vault is it's a software that we built that actually maps out debt recapture, investments, velocity banking, infinite banking. It actually will show you how to loan money from the policies, how the interest is going to work. It does all of it for you. It's an amazing software. It's custom coded just for infinite banking and velocity banking. And this is an example of it right there. So this will map out exactly how to do what I just showed you. Very simple, very easy. And yeah, Shane is one of our beta testers, by the way. Pretty cool. And we have an implementation team. So the implementation team is a group of agents on our team that's going to work with you on how to use the policy after you have it. So think of them like your own personal financial guides on how to put the policy to work. There's no cost to do that, no fees. We help you use the policies. So there you go. All right. The last topic is the Millionaire, right? So here's a question I get quite a bit. What if I have no bad debt? What if I don't need that new car? I've already got one. Can I still benefit from being my own bank? Should I become my own banker? The answer is absolutely yes, because once you have gotten rid of the bad debt, don't need to go buy a car. That's when the fun begins, because that is when you can actually start building wealth and building that legacy. So how do you do that? So, and we have a lot of clients. So these are things that they're doing in their policies to build wealth. So a lot of real estate investors, you could be wholesalers, flippers, buy and hold, commercial property. So think of like mobile homes, maybe it's investment funds, apartments, private lending, private real estate investing. So think of like as being the bank again for somebody else. They're borrowing from you and you're making a return on that. I'm going to show an example of that here in just a moment, by the way. Business owners, a lot of business owners use this as a line of credit or as a key employee insurance, things like that. Stocks and options traders, I got some guys that are really, really good at that kind of stuff, and they will borrow from the policy, put their money to work over here. Startups, a lot of startup companies, and even equipment flipping, which is one of our advisors that does that. They flip equipment for profits. Kind of interesting. All right. So what I'm going to do right now, I'm going to show you an example of a real policy and how this thing can work when it comes to private lending. So how do you build wealth with private lending? So this is an example of that with a private bank. So infinite banking. So in this example, you're going to see the side over here. It says contract premium deposits. So you're going to see 150,000 year 1, then 50,000 for the following years. Now, why 150,000 in year 1? So in this example, this person put in a $50,000 premium deposit, and they had the option to do what's called a dump in. So with these policies, you can do an additional dump in up front. It can be a larger amount of money. And the majority of that, and I'll go through it in a moment, goes to the cash value. So you can get access to a lot of cash value very quick, very early on. So that's what this person did. Now, what I want to look at is down the road. So in year 8, this person put in $48,000 and the cash value grew by $66,000. So once again, cash injection of 48, but it went up by 66,000. That's a cash on cash return of 37%. So let's look at this. What if you lent that money out, private lending it at 12%? And let's say that your infinite banking policy is going to charge 5% on that money. You're making now 44% instead of 37% because you're putting that money to work, creating more cash flow. So we did nothing different though for this person. This person, by the way, was a private lender already. They're making 12%. They're like, I'm good, making 12%. Then they looked at this and said, wait a second, if I do this, down the road, I could be making 44% cash on cash return on my money. Of course, they went and did infinite banking because it was like a light bulb moment went off. So, but we did nothing for this person other than where their money went first. That's all we changed, was where the money went first. So the question for this person and for you is, would you rather make 12% or 44%? Now, of course, this person said, yes, I'd rather make 44%. And that's what they did. So yes, they're doing a lot of, and we have, by the way, I have a lot of clients that are doing private lending through one of our platforms, and they're loving it. So how does this work? So why is this so powerful? It's compound interest, but it's uninterrupted. So what do I mean by uninterrupted? So interrupted compound interest is like, let's say you have money in the bank earning 4% and you take some of it out. Now you're not earning 4% on the entire balance. With infinite banking, you're earning interest on the total balance of the policy, even though you borrowed against it. So here's how that works. This is what interrupted compounding can do. So look at these cash on cash returns. Year 2, 21%. Year 5, 26. Year 10, 54. Year 15, 115%. That's the power of compounding. Access to capital, 121, 126, 154, 215. It just keeps getting better and better. So that is obviously the marathon right there, but that's why this thing can work so well, because of that uninterrupted compound interest. Now, people say, how do you build wealth? Well, I already kind of gave an example of it right there, but it's, it's time, right? So how to eat an elephant, it's one bite at a time. And the other kind of thing we always say is, how did the man at the top of the mountain get there? He didn't just fall there. Well, he took that first step. And this is kind of one of my challenges to a lot of people is, the people that you see that are very successful, that are at the top of the mountain, that are where you want to be, they took an initial step. They did something different. And for the guy at the top of the mountain, he didn't fall there. He took that first step and he started climbing, right? And a lot of people don't want to do that. They'll just walk around the mountain, look at the guy saying, look at that guy. He sucks, right? But guess what? He did something different. And so once again, infinite banking is definitely something different. And as you can see here, it can get different results too. And I got some more examples I'm going to go through here in just a moment. I'm going to show some actual illustrations so that you can actually see the numbers. So this works for debt. It works for expenses. What else can it work for, right? Lots of things. So one of the examples that I kind of show real quickly here is the example of the doctor. So remember the doctor? So if he had paid his condo and his house back as promised to the banks, right? The math is pretty simple. He would have paid $493,000 out of pocket. So he would not have that money anymore. Now, if he'd had infinite banking in place early on and could have bought those properties with infinite banking, and let's just say that he had a 4% rate that he was earning dividends on, it's actually higher than that, by the way, but we're conservative, he would have made $749,000 and still own the house and the condos outright. So that's a swing of negative 493 to a positive 749. All right, so now that you know how this works, I believe that everybody should do this, because here's the thing. This creates generational wealth guaranteed. It's one of the big things why people do this. The next step here, and by the way, I got more slides that we're not done yet, but I want to give, for those of you that have to take off because we're almost at the top of the hour, I want to give you my my email and my personal call link. So it's right there on the screen, brian.beyourownbanker.com/TBCT. That is my personal call link. I'm going to put it in the chat box as well. The next slide I want to share, this is kind of a funny one. This is kind of the mindset shift that we want to make in life. So most of us are at the bottom. We're working for our money, but we want to be the one at the top. We want our money working for us. So that's what being your own bank can do, right? Here's some things I want to share that are very powerful, but we don't typically talk about a lot of infinite banking. So I'm going to talk about the death benefit for a second here. The loans. So the loans are your loan. So we're going to talk about how those don't have to be repaid. The value, the dividends, they grow tax-free inside the policy. The policies, they are exempt from judgments, from liens in most states. So it's a protected asset. And you can also create tax-free income in retirement with these policies, because guess what? Loans do not have to be repaid and they're not taxable. All right. Now, let's talk about the death benefit for a second here. This is the generational wealth or legacy aspect of infinite banking. So what you're going to see over here is the death benefit. Now, this person, this is a female, age 42. This person is putting in $20,000 per year. So you'll see that for the first 5 years, and then she drops that premium down to around $3,000. You have that flexibility. But look at this. So in year one, she puts in $20,000, but the death benefit is $325,000. Do the math on that. That is significant, significantly higher than what she's put in. God forbid something happens. We don't want anything to happen early on, but what if she got hit by a bus? Her $20,000 is going to create $325,000 of wealth. But here's what you'll notice. Year two, 20 goes in, death benefit jumped up. You'll see this year over year over year, the death benefit is always increasing. In fact, in the first 7 years, it went from 325,000 to basically $500,000. And guess what? That death benefit is going to grow for the rest of your entire life, does not go down, and it's tax-free guaranteed. If you understand that one thing right there, you'll understand why wealthy families do policies like this on every single family member when they're born. When they're born, they get a policy right away. This is exactly why. Imagine if you get a policy on someone who is 2 years old and they live to 85 years old. Think of the compounding. Think of how much the money they put in that policy is going to turn into down the road. 10 to 15 times, by the way, tax-free guaranteed. All right, let's talk about the policy loans really quick. So the loans are guaranteed. So basically ask and you shall receive on those loans. Okay. There's no credit check. There's no approval. You log into your policy, hit request loan, and it shows up in your account. That's pretty simple right there. That's how it works. They're private, by the way. So the loans, when you borrow against these policies, the loans are private. They do not go on your credit report. They're not there. They're private. So they don't show up and they don't affect your credit. There are no minimum or maximum payments on the loans. So if you go buy a car with a car loan, right, and you don't make a payment, they're going to take your car. Additionally, who has the title? The bank does. With this, if you don't make a payment, nobody cares. No one's going to come talk to you, and you have the title. So it puts all the control in your hands. Miss a payment, nothing happens. So the payment is actually up to you. You choose when and how to do that. And actually, we help you with that. If you want to, hey, how should I structure this loan payback? We'll actually help you with that. Another quick question I get quite a bit is how can I fund my bank? So I know that, I think, Kurt, you asked that question. So you can do it monthly, quarterly, or annually for the premiums, or even semi-annually. So that's how the premiums work. The minimum to start a policy, not the recommended amount, by the way, it's just the minimum, is going to be 10 times your age per month. But the maximum premium deposit is going to be dependent upon the individual. It's your age, your income, and some other things. So I can work with you on what that number is, but think like 25% of your gross income for the annual number. That's kind of essentially what that number would be. On top of the premium, so you have the option to put in an additional amount. You don't have to, but you can put in what's called a dump in, like a large amount. 50,000, 10,000, 100,000, whatever. So you can do that, and that will overfund the cash value, because when you put money into these policies at the very beginning, anywhere from 50 to 90% or more goes with the cash value. And I'll work with you on what that number is. And the last thing here is, well, would you put in $1 to get $3 down the road? So I'm going to show you exactly what I mean by that, because when you understand how this works and the longer it's in place, the more efficient it becomes, you're going to understand why I would ask that question. So let's kind of talk about a policy example of how these things can grow and what I mean by that. So I want you to look at this policy. So in this policy, this person put in, this is a female age 32. She's going to do an annual premium of $10,000 per year and a 50K dump in. You'll see that right here. So 60K went in year one. But look at this. At the end of the year, this is 12 months later, she has access to $55,000. If you do the math, that's 92% of what she put into it. So she has access to 92% of what she put into it. But look at this. Look at year two. In year two, she puts in $10,000. The cash value went up by over $10,000. So you can see how efficient this policy is within year two. It's already efficient. But look at this. Look at year 11. So she decides to decrease her premium. So she decreases premiums to $3,000 and change. But look at the cash value. It jumped up by $10,590, more than 3 times what she put in is what it went up by. So that's the question I asked on the previous slide was, would you put in $1 to get $3 back out? So as you can see, the longer these policies are in place, the more and more money you're going to get back out of it. Yeah, so Shane, we call this kind of planting the money trees. So policies to me are kind of like planting a money tree. The more it grows, the more money it's going to produce. Now, this is a quote that I actually don't really like, but I always want to share it. And it's by Warren Buffett. And he says, if poor people would just do what rich people do, they wouldn't be poor anymore. I don't agree with that. My example of this, or my way of stating this would be like, if poor people had the knowledge of what the rich people do and took action on that knowledge, they wouldn't be poor anymore. Because knowledge is just knowledge, but knowledge plus action gets you results. So I've been teaching infinite banking for 9 years. I got to update that slide. But yeah, I've been teaching this for about 9 years. I've helped thousands of people understand infinite banking. I've been doing webinars on infinite banking for, I think, 8 years or 9 years. So here at the BYOB and the Money Multiplier, we have an entire team of over 40 people that work with you on how to set up the policy. We are the largest producer of infinite banking in the US, or like the second largest, or I think we're the first largest now, of infinite banking. So that's all we do. Me personally, I have probably over 100 clients right now in underwriting. So I work with a lot of clients. I write a lot of policies. That's what I do. We also provide ongoing support and services. So a lot of people out there that are, I don't want to say selling infinite banking, but are doing infinite banking, they don't have a lot of support and a lot of additional services. We do, and there's no cost for that. So we have a full team that will support you today and after you have a policy, so to make sure that you're using it correctly. And we don't charge you for that. So there's nothing for that. Our software, some of our softwares do have like a subscription model, but that's a bit different. The other question I get quite a bit, and this one I get a lot, is IUL or VUL infinite banking? The straight answer is no, it's not. You can go Google this, you can go look it up, you can use Chat GPT to get a good, like a long answer if you want to it, but no. IULs, VULs, and term insurance, they pay some of the highest commissions. IULs are not infinite banking at all. Term insurance is not even close. It's its own thing. But whole life has been around for a long time. IULs have not been around for a long time. IULs have a lot of lawsuits out there. They have a lot of complications. They have surrender fees and charges, and they're complicated, and they can actually lose value. Believe me, I have personal experience. I have a VUL, and if I kept that thing for my entire life, it eventually would go to zero, and I'd lose the entire thing and the death benefit. Additionally, with whole life insurance, the death benefit is guaranteed. With IULs and VULs, the death benefit is not guaranteed. That is one of the biggest issues right there. Also, to do infinite banking, we take a 70% cut in commissions versus traditional life insurance or IULs. And I do the math for this for you. I actually will literally show you the math. I have even looked at other people's policies, and I've shown the math to the client because they didn't understand how the commissions are built into that thing or how they're calculated. And they were not very happy when I explained it. So yeah, so we take a big cut in commission, and we only do infinite banking, by the way. IBC policies, we don't do other types of things. We don't do car insurance, home insurance. We just do infinite banking, and obviously that's our main passion right there. The last thing I'll kind of mention here is that there's one of two things will happen to us in life, right? We're going to live, obviously. And so the question is, are we better off with or without this in our life? The second thing that's going to happen is we are going to die. It's apparently it happens to everybody at some point, but are we better off with or without this in our life when that happens? Now, for me, when I first came across infinite banking, it was kind of like the tale of two people. So I was like, who am I going to be? Well, when I first heard about this, I was like, you know what? I'm going to be group one kind of person. I don't need any help. I'm going to go do this. Well, guess what happened? That was what I told myself. I heard about this from someone who knew what they were doing, but I said, you know what? I don't need their help. I'm going to go talk to my buddy over here, who was a life insurance guy. And he sold me the VUL, by the way, that was disastrous, that lost me 6 figures of potential wealth. And I didn't know that's what happened until years down the road. Once I learned that, then I said, you know what? I'm going to be part of group two. I want to go learn this. And that's when I eventually got a mentor on infinite banking. That was one of Robert Kiyosaki's advisors. And I really learned about how this really worked. And I said, you know what? I want to work with the best team that does this. And so when I said, hey, I'm going to help a lot of people do this, that's why I'm part of the BYOB and the Money Multiplier team, because guess what? I believe that they're the best at doing this. And that's why I'm here. I was group one at the very beginning. I went alone, but I'd recommend group two, to be honest. Yes, is that self-serving a little bit. So here's kind of the next steps. And we're at the end of the presentation, by the way. So it's pretty simple. Let's hop on a call. I'm going to put my links right there in the chat box. Hop on a call. Let's solve your problems. If you have any questions, we'll go through those. And honestly, let's just see if infinite banking is a fit for you. Now, I'm not going to tell you that infinite banking is a fit for everybody. It is not. In fact, only about 5 to 10% of the population can qualify for infinite banking. So to do this is actually a massive privilege. It's a massive privilege. And so if you want to hop on a call, see how this can work for you, grab my link up there, and we'll definitely go through any questions you have, go through your situation, and see how this can work. And the last slide I'm going to end on is this one. Now, this was the quote that I started with at the very beginning, but it kind of has a different meaning now after the presentation. The problem in America isn't so much what people don't know, it's what they think they know that just ain't so. So when it comes to money, when it comes to debt, that's a lot of the issues right there. All right, everybody. Appreciate all the questions. Appreciate you being here, and look forward to talking to you all soon.